about to leave, already packing. Come with me, I'm not really asking. We'll get away to a place where we don't know. About to see the world in action, what we can be, life with no distractions. We'll get away, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out. Die with my own doubts. Be free with me. Let's go, let's be free with me. Be free. Not looking back, eyes on the freeway, Bonnie and Clyde, a classic cliche. We're on the run, this is what we waited for. Take my hand, we'll make it somehow. We can't miss out. I'm done living life with the lights out. Die with my own doubts. Be free.
Good morning, everyone, and welcome to the latest, our 23rd live A-Level Economics Revision Blast. And it's Jim here at Studio HQ. I'm joined today by John in the middle, which means that Jeff is on the right-hand side to guide us through this fast-paced, around about 30 minutes or so of a revision on costs, revenues, and profits. And John, do you want to give us a flavour for what we're going to cover, and then we'll crack on?
Thanks, Jim. Morning, everybody. Yes, like every Big Six football club, we're going to concentrate on profits today. No, we're not. We're going to look at costs, revenue, and profits. Now, we're really aware that this is one of those subjects that many students find fairly straightforward. But examiners are telling us a huge number make silly errors when they are undertaking questions on cost, revenue, and profits. So set yourself a challenge today. We've got 30 minutes of fast-paced activities. Set yourself the challenge of getting every single question correct if you can. So if we're ready, gents, shall we make a start?
Okay.
So straight in, I'm only going to give you 30 seconds for this activity. I want you in the chat window. So we've got a chat window available to you. You can normally type in short answers, but this time I want some proper sentences or proper phrases. Give me 4 examples of fixed costs. 4 examples of fixed costs. I'm looking to see if I can get as many as I can in the chat window. My 30 seconds are going to start now. That Jim's going to start my clock for me. 4 examples of fixed costs. Fixed costs, of course, are those costs that don't depend on your level of output, are not dependent on level of output. They don't change as output changes, whether output goes up or goes down. Fixed costs remain the same, as the name suggests. So can anybody tell me an example of a fixed cost? I'm back across to the chat window. Nice to see so many people joining us today. If you're here, if you're watching this on catch up, You can take a little bit longer than 30 seconds, perhaps. Let's see if we get any suggestions on the chat window. I'm having a look, just seeing if I can get thank you to Nikita, I think he's the first one in, with rent. Mark came next. He also said rent, insurance, wages, property tax. Any others just before we reveal our answers? Thanks to those two. Yes, Nikita have gone back to wages as well. Let's have a look at R4 then, if we can. Jim, let's have a look on screen. What have we got here? We've included rent as well. That's the obvious one, the one that most students will use. I haven't said wages, I've said salaries. Now, remember, wages can be paid to staff, and staff, you may increase the number of staff that you have or decrease the number of staff that you have, depending on your output. So we tend to use the word salaries, the sort of fixed wages that go to people who constantly work for an organisation. Insurance costs generally have to be paid no matter what the level of output is, and advertising tends to happen before production or before the output happens anyway, so advertising costs tend to remain fixed. Thank you. Let's move on to our second activity, and thanks to those who got involved. Quick one, using a bit of quantitative skills. I want you, and it's the first time we've ever tried this activity actually, I want you to actually compose a formula for me. Now again, this should be fairly straightforward, but most students who make mistakes when it comes to their quantitative skills make mistakes by just not getting their formula correct, not writing it out really quickly before they have a go at the numbers that are presented to them. So I want you to use the elements that are at the bottom of the screen to create a formula for average fixed costs. We just mentioned what fixed costs were. Our average fixed cost curve, we'll talk about that in a second. What formula are you going to use? Have a look at the elements at the bottom of the screen. I know it's maybe not quite so easy to type those in into the chat window, but let's see if we get anything from anybody there. Average fixed costs, what do they look like? What's our formula? Let's imagine you've been presented with some data in an exam, in an assessment, and you've got to quickly write out the formula to make sure that you don't get it right. You don't get it wrong. What are we going to go with? Have we got any suggestions? I'm having a look at the chat window. I think people are thinking about this and then thinking about how they're going to type it in. Let's have a look on screen then. Shall we have a look on screen? What should our average fixed cost formula look like? Here we go. Here are our different elements. It's our total fixed costs. So when we talked about fixed costs in the first Give Me 4 activity, total fixed cost divided by our total output, that will give us an average fixed cost, and our average fixed costs generally should be like a downward sloping curve. And thanks to those of you who are sending through your formula now. Right, let's move on to our second one, our second broken formula. Total revenue. So we had average fixed costs in our first one, and this time total revenue. Exactly the same activity though. Elements at the bottom of the screen. What can you tell me in terms of possible formula here? Again, same process. We're trying to make sure that we get our formulas correct so we can apply our numbers and not make any errors there. So again, I'll have a quick look at the chat window. Henry looks like he was the first. Sorry, no, it was Brian, I think, was the first one with price times quantity. Just wait to see if anybody's got anything slightly different. Nikita again with price times quantity. Let's have a look at our answer then, Jim. Were Bryony and Nikita correct? Absolutely. Price times quantity. So total revenue, price times quantity. Thanks for that, guys. Thanks for partaking in that. Let's move on then to our next little activity. Some multi-choice questions with Jeff.
Okay, thank you, John. We've got 4 multiple choice questions for you. These are all past paper questions. So here's the challenge. Try and get 4 out of 4. Here's the first one. In order to maximize total revenue, a monopolist should increase output up to the point where? 4 options, of course, A, B, C, or D. If you're with us on the live session today, post the answer in chat. Let's see who can get 4 out of 4. When this is a monopolist that's not a profit maximizer, perhaps a revenue maximizer, an alternative objective. Quite a few answers coming through. A lot of people saying D, quite a few people saying B. Keep in mind, of course, when the monopoly, that the average revenue curve will be downward sloping, and therefore marginal revenue cannot be equal average revenue. So the answer can't be B. Let's take a look at the answer, please. And the answer is D. You maximize revenue where marginal revenue is 0. This is an incredibly important point for revision, everybody. Please know your different conditions: profit max, revenue max, sales max, etc. Revenue maximization is an alternative objective, and you maximize it to where the marginal revenue curve is 0. Well done, those of you who got the first one right. Here's the second question. coming up. An independent food retail firm is in a very competitive market and decides to cut the price of their product. As a result, total revenue falls, but marginal cost rises. Which of the following can be correctly inferred about the firm's costs and revenues over this range of output? Now, a lot to read here. Take a moment. If you're watching live, post the answer in chat if you're confident. If you're watching on the replay, maybe press the pause button. Give yourself a few seconds to read through the options A, B, C, and D. So they've cut their price, revenue's gone down, but marginal cost has gone up. So what is that suggesting about the nature of their revenue and costs? So what do we think of the answer coming through here? A few people saying B, a few people saying C, a little bit of a difference of opinion. So indeed, Elliot's saying we've got our backs to the wall. The answer is B. Well, let's check. And the answer is, in fact, C. Now, keep in mind that this is a competitive market. If you cut your price and revenue goes down, the elasticity of demand must be less than 1, the coefficient. So you must be on the inelastic portion of a demand curve. Lower price leads to lower revenue. The elasticity coefficient will be less than 1. If marginal cost is going up, that implies diminishing marginal returns. It's the reason why the marginal cost curve is assumed to slope upwards, that the productivity of extra factors of production goes down as you employ more of them. So you get what's called diminishing returns. I used to have a very funny joke, by the way, about diminishing returns. I won't tell it again today. It's just not as funny second or third time around. Let's try number 3. Now, this is a calculation question. Expect quite a few of these in your assignments and exams. Brit Variant Limited has fixed costs of £12 million. It has an output of 150,000 units, which have a variable cost per unit of 150. Here's the question, and you'll need to spend a few moments calculating this. What are the total annual costs of the business? So we're given some information there. Fixed cost of 12 million. The output is 150,000 units. And you're told that the average variable cost is £150. The question is, what are the annual total costs of the business? And let's see if we get some answers coming through live on the chat window. I'll take you through the answer in a second or two. Those of you watching on replay later on, again, press the pause button and give yourself a moment or two to make the calculations. Most people here are saying D. It's a great flow of answers coming through, so thank you for that. Let's double check, Jim, please, with the answer. And the answer is indeed D. Superb. Now, output 150,000, variable cost £150 per unit. So you multiply 150 by 150,000, that comes to 22.5 million. Add the 12 million of fixed costs, giving you a total cost of 34.5 million. And here's our fourth question in this little cluster of questions. A firm realizes that if it either increases or reduces its level of output, then its short and average cost goes up. It must therefore be the case that what is happening? If you either increase or reduce the output level, then the short and average cost goes up. Have a go at this question. The way to visualize this is to think about a U-shaped average cost curve and think about marginal cost and where it intersects with average cost. If you can visualize your cost curves, this will make it easier for you to answer the question. And the answer's coming through. A lot of people thinking here it's B. Let's just double check. And it is indeed B. Firms producing at the lowest point of average cost, where marginal cost equals average cost. That was a great set of answers. Terrific on that. Now let's move on to another quiz, one of our favorites. I've got a couple of bubble quizzes for you here. In this quiz, those of you who've been with us on many sessions will know this quiz is a fantastic little activity. We're going to give you a statement and you have to tell me how many answers are correct. It can be 0, 1, 2, 3, or 4. And in the live window, post your number of correct answers, all the letters. Which of these can affect the profitability of a firm? Which of these can affect the profitability of a firm? Is it changes in variable costs? Is it contestability within the market? Is it the rate of growth of market demand? Is it the price elasticity of demand? Which of these variables affect the profitability of a firm? Is it none of them? 1, 2, 3, or 4? If you're with us live, maybe post the letters of the things that you think are correct. So quite a few are saying 3 factors, but which 3 affect profitability? Harry has gone for 4. He thinks all of them affect profitability. The Force of Tiger has gone for a full house, and Finn has said all of the answers. What do we think? Let's have a look at the answers, please, Jim. And indeed, congratulations. Well done, Finn. Superb answer. All of these factors affect profitability. Variable costs, affecting marginal cost of production. Contestability, of course. The threat of entry affects the prices that firms charge. The rate of growth of demand affects profitability. And crucially, of course, the elasticity of demand affects the ability of firms to price well above cost. Superb answers. Well done. Number 2, the second in our bubble quiz, slightly different time. This time we just got 3 bubbles. In the diagram on the bottom right there, at what output levels would this firm have a marginal profit that is positive? Marginal profit, of course, is a key concept. Do you make a profit on the next unit that you produce? Crucial decision for many firms. At the margin, do you make a positive profit? So at what output level would this firm have a marginal profit that's positive? This time, just 3 bubbles, A, B, and C. What do we think? Which of these are correct? What do we think on this one? And again, the answers are coming through. Thank you to Jacob. Jacob thinks it's B. 1 or 2 answers coming. Yeah, great question coming through. Is normal profit classified as positive profit? It's not super normal profit, but normal profit is a positive profit in the sense that the firm is making enough profit to justify staying in the market in the long term. And we build the normal profit into cost. Let's have a look at the answer, please, Jim. Most people are saying B, and B is their correct answer. A and C are not. A is marginal revenue equals marginal cost. That's the profit maximization point. The marginal profit is 0. And C is incorrect. The marginal profit becomes negative beyond that crossover point. So the answer there is indeed B. Well done on the 2 bubble quizzes. I'm going to hand over to John, I think, for some confusing pairs.
Thanks very much, Jeff. So yes, on screen, we've got a couple of confusing pairs. Now, we do this one because we're testing some definitions and we're just checking that you get them the right way around and don't confuse them with other phrases. So I've got long run and short run on screen. And what I want you to tell me is whether you think that the 2 definitions which are next to them are correct. And if they're correct, just say, yes, they're correct. If you think they're the wrong way around, then just say, swap them around or swap. So are the 2 definitions for long run and short run correct? So say yes, they're correct, or should they be swapped? So we're getting some answers in. I think Agnego was the first one in, and they've gone with wrong. Swap them. Marcus said that they're wrong. We're getting lots and lots of swaps. So have we got this the wrong way around? Let's have a look. Are they the wrong way around? They are indeed. So short run is that time period where at least one of our factors is fixed, whereas we know in the long run, all factors should be able to become variable. So even our factories, we can move factories, we can even move countries, can't we? So in the long run, all factors become variable. Let's try another confusing pair then, a second one. This time we've got cost plus pricing and shutdown pricing. A little bit more for you to read this time, so I'll give you a little bit more time. Have we got those 2 definitions the right way around? Or should we be looking at swapping them? So correct again if you think that they're right, swap if you think they're incorrect. So like I say, a little bit more to read this time. So let's just give you a few moments before we have a look what comes up in the chat window. Jacob thinks they're correct, whereas Nikita thinks that they should be swapped as, I think Jacob's changed his mind and he's gone to swap. Are these the right way around or should they be swapped? Let's just wait and see. Give you a few more seconds to have a look what kind of answers we're getting in. Brian has gone with swap. Henry's still thinking about Spurs and their profits, no doubt. And Mark has gone with swap. Let's have a look, Jim. Are they the right way around or should they? Of course, they should be swapped. So shutdown price, one of those really key concepts that we need to know about when we're thinking about business costs and revenues. So in the short run, businesses need to make sure that they are at least covering their fixed costs. fixed costs, they're going to have to pay anyway, aren't they? Fixed costs, no matter what output, even if a firm shuts down, they're going to still have to pay those fixed costs. So as long as the average revenue that's coming in is greater than the average fixed costs, then that firm can continue to operate. As soon as the price becomes the same as average fixed costs or starts to go below that, the firm might as well shut down. So that's why we've got that shutdown pricing, whereas cost plus pricing is one of those concepts where we add on a percentage on top of our costs to come up with our overall price. Okay, next activity, if we can, then, Jim. Suitcase Scanner. Suitcase Scanners, then. Now, I don't know if you've seen this one before. We debuted it only last week. So the idea is I'm going to run a little airport scanner over my suitcase, and it will reveal a diagram. Now, I want you to have a look and see what that diagram is, but also I want you to tell me, what is it actually showing me? What is it actually showing me? So what is it showing me? It's not just about what the diagram is, but what is being shown on the diagram. So my scanner is going to go over the suitcase. It'll be really, really quick, so pay very careful attention. Here goes. And Jim, will you please reveal the suitcase scanner? So what do we think we've got going on here? What is going on in this suitcase scanner here? So I'm waiting to see if I get anything in the chat. What was on that? What was on that? Elliot's mentioning something about contraband. That's not what's in there. Nikita's gone with Rev Max, Revenue Max. What is in that diagram? Monopoly diagram. So Jacob, yeah, I think you could take, it might apply to a monopoly. Harry's gone with Rev Max as well. Let's have a look at the answer, Jim. It is indeed where our revenue is maximized, and we've got our little area that's been identified there, which is showing supernormal profits. So we've got revenue max is at where our marginal revenue equals 0. So it's not profit maximization, we've got revenue maximization, but we know because our avenue revenue is above our average costs, we are going to make some kind of supernormal profits. Let's try another one. Let's try a second one then, if we can. So again, you're having a look on this one. What is this diagram showing? So you'll be able to identify what the different elements are, but what is it trying to show me? So let's run our scanner. Pay really very careful. There's a lot of information on this diagram. In fact, there are 2 diagrams in one. So have a real careful look as it goes back again. What is that showing? What is that showing? Let's see what the chat window says now. If you're watching this on catch up, you can always run that again if you want to have another quick look. What do we think this one is showing us? Mark has said perfect competition. Actually, I want a little bit more than that, Mark. You're not far off, but I wanted something a little bit more than that. See if anybody else has got. Jeff thought it was a tough one. Perhaps that scanner went quite quick. Harry's come back with revenue curves in competitive and non-competitive markets. Finn said something very similar to that. Nikita's gone with market and firm revenue. Let's have a look, Jim. Let's have a look. Let's put people out of their misery on this one. It is indeed. It's showing that average and revenue curves for competitive and non-competitive markets. We know that firms in a competitive market are price takers, so that average revenue, margin revenue tends to be the same at all levels. So we get that horizontal line, whereas price makers in non-competitive markets will charge different prices at different levels of output, hence the downward sloping average revenue and marginal revenue curves. Thanks for that. We'll go back to a few more multi-choices with Jeff.
Yeah, let me challenge you. There's no hiding. These are 4 pretty challenging questions. Try and get 4 out of 4. If you do, that is superb. Here we go. The diagram below on the right-hand side there represents the cost and revenue curves of a business facing a downward sloping demand curve. Which one of the following cannot be correctly inferred from these diagrams? These are some of the new style multiple choice where they give you 3 correct stems, but 1 stem from A, B, C, and D is incorrect. So you have to read through it, go through it sequentially. Downward sloping revenue curves, which one of the following cannot be correctly inferred from these 4 statements? So we'll take a moment to see if people can post the answer in chat. And those of you, of course, who are on the replay can press the pause button and take a moment to read through the answer at your leisure. What cannot be inferred? 3 of these are correct. You're looking for the incorrect stem. Can we see any answers coming through? A couple more seconds to see if we have any questions coming through. And we have 2 people saying A. Well, let's double check on the answer, please, Jim. The answer is indeed A. Beyond point B. B is the revenue maximizing point where marginal revenue is 0. Quick bit of revision here, of course. MR is 0 at the halfway point of any downward sloping linear demand curve. And of course, the AR and MR should be drawn starting together for accuracy in exams. We really believe in practicing drawing diagrams ahead of your assessments. They can make a big difference to your assessed grades. Here's our next question. The diagram below shows some pretty standard cost curves: marginal cost, average total cost, and average variable cost for a business. Which of the following does the distance between ATC and AVC represent? So what are we measuring? What are we showing in the gap, the closing gap between ATC and AVC? This is a familiar question. It's appeared several times, different examples over the years. What do we reckon for question number 2? The gap, the vertical distance, if you like, between average total cost and average variable cost. Alfie's gone for C. Jacob's gone for A. Interesting answers coming through. Harry's gone for A. Let's check the answer, please, Jim. It is indeed A. Average cost is average fixed cost plus average variable cost. So if we know what the variable costs are, the difference must be the fixed cost per unit. And can you see there on the diagram that the vertical distance, the gap between ATC and AVC is getting smaller? And that, of course, tells us that the average fixed cost per unit always falls as output goes up because you're spreading your fixed costs. Well done on that one. 2 more multiple choice questions to go. A monopolist is facing a standard downward sloping demand curve, average revenue curve. Which of the following diagrams correctly represents his or her total revenue? So if the monopolist has a downward sloping demand curve, AR falling, MR falling below it, what's the total revenue curve consistent with monopoly? What do we reckon on this one? Answers again coming through, which is fantastic. And the consensus seems to be C. Let's double check with the answer, please, Jim. And the answer is indeed C. B would be perfect competition because the price per unit is the same. So the greater the quantity, the more the revenue keeps rising. Of course, total revenue is a non-linear function of the downward sloping average revenue curve. And here's our final multiple choice question today. How would an economist explain the shape of short-run marginal cost between output levels A and B? So there is a marginal cost, the change in total cost as a result of producing 1 extra unit. As output moves up from A to B, marginal cost rises. It's essentially a supply curve for a business. So how would an economist explain the shape of the short-run marginal cost curve? Answers are coming through. Yeah, okay, let's have the answer, please, Jim. The answer is D. Well done. I think quite a few of you got 4 out of 4 there, which is fantastic. Keep in mind that some people in the exam will have chosen B. The law of diminishing marginal utility, of course, explains the downward sloping demand curve. Nothing to do with costs. The economies of scale, of course, is long-run cost, whereas the diminishing returns shown here is short-run cost. Well done, superb. If you got 4 out of 4, tell me in chat and take a bow. We'll give you a hat tip and a round of applause at the end. Fantastic answers, superb. Well done, Jacob and others. Let's finish our session there with a higher low again. We love this exercise. We've been looking at revenues. John, I'm gonna quiz you on this.
Oh, okay. Here we go.
I might even get Jim to chip in with the answers as well. So we're going to give you a number of firms, and these are their revenues in millions of US dollars in 2020. And the question is, are the revenues of the next firm higher or lower? So Royal Dutch Shell had revenues in 2020 of, the answer is coming up now, $344 billion. So the next company is Volkswagen. did they have higher or lower revenues than Royal Dutch Shell last year? Just to answer, if you're with us on the live session, just post higher or lower. What do we reckon? Jacob's gone lower, Tom's gone higher. John, what do you think?
It's a tough one, this, isn't it? We know that the oil industry and the car industry struggled last year because of lockdowns and pandemic. I'm going to say the oil companies did better. So I'm going to say that Volkswagen had a lower revenue than Dutch Shell.
Ollie's gone lower, Alfie's gone lower, Elliot's gone lower. There's quite a few of the team here have gone lower. Let's have a look, Jim. And indeed, Volkswagen had substantially lower revenue. They took a big hit, of course, last year with the pandemic and also maybe their reputational damage after the emissions scandal.
Yeah, I was going to say lower, John, but I was guessing 283 billion. I was just, I suppose you're rounding the numbers slightly lower, but yeah.
Well, compared with Volkswagen, what about our next business? Here we go. Apple. Did Apple have higher or lower revenues than Volkswagen?
That's an easy one, Jeff, surely. That's got to be higher, hasn't it? Apple?
Yeah, I'm not so sure, John. I don't think Apple sells anywhere near as. I think they're very profitable, but I don't think their revenues are anywhere near as much as that. I'll go lower.
Well, Apple revenues took a bit of a boost yesterday. I bought myself a new iPhone. Have you got an iPhone, Jim? And John, are you Apple fans?
I'm not.
Yeah.
Yeah.
Well, don't forget, if you bought it yesterday, that won't be in their 2020 revenues. But notwithstanding that, I still think Apple's revenues will be much, much lower than Volkswagen.
I bought myself an Apple, by the way, just for the purpose of the video. I bought myself an iPhone 16, which is a very high-tech phone. Yeah, the screen touches you, so it's the next generation. What do we reckon? Let's put the answer in there. Apple's revenues higher or lower than Volkswagen's? In fact,
much, much lower.
Wow.
Yeah.
Wow.
This is an interesting point that Apple is one of the most profitable companies on the planet, but of course, profitability is not the same as revenues. Apple is a highly profitable company, but revenue is actually lower. What about the next company, Jim? Two to go. Amazon.
Well, I'm going to say higher again, but after the Apple one, Jeff, I've lost a bit of confidence. But surely Amazon, especially during lockdown, everybody's buying from Amazon now, aren't they?
Got to be higher, isn't it? Got to be, John. I agree with you, mate.
I would have thought so.
I'll bet my reputation on it being higher.
Oh, that's betting a lot.
Corey Noodle says higher. Oliver says no way, it's lower.
Okay.
And Harry says, "Come on, Jeff." Well, thank you. What's the answer?
There we go.
In fact, the highest of the companies so far. So Amazon, of course, has $100 billion more revenue than Apple, but makes lower profits. Apple is a much more profitable company. Here's our last one.
That's hard.
Walmart.
Now, no, Walmart are a big company. I know that, and I know that they traditionally do very well in these kind of things. But could they have? They can't have beaten Amazon, surely. Not last year. So I'm gonna go with lower. I think.
Jim, what do you think?
I'm going higher. I think Walmart sell a lot of Apple stuff. They sell a lot of stuff. They own Asda, or they used to own Asda, but Asda was owned by them in 2020. Yeah, I'm going to go higher.
Interesting with Walmart. My favorite anecdote with Walmart, when there's a storm or a hurricane brewing or some extreme weather, they lower the prices of their wood and their shovels and things. Their thinking is if you cut prices when the winter comes, people will return to you in the summer when the sun is shining. Thank you for that anecdote, Jeff. Here we go. Here's Walmart's number, and it's absolutely huge. Walmart has the
Unlucky, John. Unlucky, mate.
Yes.
In the world. It's staggering. Jim, we forgot to include Tutor 2 on this list of. Where would Tutor 2 be?
It would be if you added it in there, it would be one of those five, alongside one of those five. Yeah.
Staggering. I don't know if you know this, by the way, but last year Apple and Tutor 2 together collectively had profits of $93 billion.
It says true.
What a year! Well done, most people got it right.
Well done. Better than me.
Can we hear you, Jim?
I thought it was just
you can now. Yeah, I was just saying, I've been keeping an eye on the chat. Loads of students joining us, and lots got nearly all of those questions right, which is fantastic. I've identified 6 students who did particularly well. I won't name them, but they will be founder members of the ESL, the Economics Super League, starting next week with our next live sessions.
Excellent.
That's great answers on the multiple choice. All the multiple choice thing, we had 8 today. They were all past paper questions.
Yeah.
So if you got 8 out of 8, that's
Tough
20%.
ones. Yeah.
Great session. Thanks, John.
Tough stuff.
Cheers, Jeff.
Yeah.
So right, we're
thanks,
back
Jim.
again, John, tomorrow, aren't we? Lunchtime, I think it is.
Thursday.
What am I talking
Oh,
about?
you could no, you could be right. I've forgotten, Jim. Sorry. Yes, you
think
could
it
be
is.
right tomorrow. Yes.
Yeah, Wednesday
Yeah,
lunchtime.
yeah.
Economic growth.
Yes.
And we've added all the new sessions for economics live sessions over the next 4 or 5 weeks. If you go to tutordu.net/live, you can see all of those sessions coming up, but also catch up on the previous 23, including this sessions on just all the topics that you could possibly want for A-level economics. Download the PowerPoints and more. I think we've done about 140 sessions now, so lots of other A-level subjects covered. If you're doing A-level geography, sociology, psychology, business, politics, or law, which starts on Thursday, there'll be some sessions for you as well on those subjects. So many thanks for joining us. Hopefully we'll catch you on a live stream coming up later this week or next week. So thanks for now.
Take care.
Bye, everybody.